So Baba is down about 6%, meaning of our portfolio we've lost about $50,000. So hi, my name is Zach and I am a popular investor on eToro. And I want to help you manage your finances by showing you how I do it for myself, as well as 9,000 copies I have on eToro. Just a quick reminder, none of this is financial advice. Do consult a licensed professional should you need it. So Baba announced earnings yesterday, and obviously the market reacted badly to it, and that's why the stock is down. The key number that you need to see is this right here, which says net income had a decrease of over 96%. And that's the number that a lot of people are focusing on. However, looking deeper at the numbers, we can see it's not as bad as it's made out to be. So this is why it's actually important to look at any of the investments that you make on your own or through whatever broker. And if you have a vested interest in trying to manage it yourself in general, it's really important to look at these numbers. And for our portfolio, this is actually a pretty significant part. As you can see on the eToro platform, we have around 5-ish% invested in Alibaba through the Hong Kong entity. And I don't really like purchasing the US entity just because it's not native. It doesn't make as much sense to me, so I prefer the Hong Kong entity. And also, back when we bought it, there was a lot of discussion about delisting on the American ADRs and things like that. So it wasn't worth the risk. I decided to move everything over to the Hong Kong side of it. Okay, but anyway, getting into it. So they did say that they delivered a revenue growth of 7%, which is positive. But again, this loss of 127 million is the main thing most people are focusing on, hence the big reaction. And you can see it's primarily attributed to net loss from their investments, right? Net loss from investments in publicly traded companies during the quarter compared to the net gain in the same quarter last year. And this is due to mark-to-market changes, okay? So what this means is actually, if you were to buy a stock at $100 and it drops to $50, you have a $50 loss, right? But this is a paper loss. Generally, you don't realize it as a loss until you sell it. However, there have been some accounting changes, I believe, and these accounting changes make it such that they do need to market to this change in the value of the company itself. Hence this, mark-to-market loss. So if you exclude these share-based compensation, gain, loss from investments, blah, 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 there was a decrease of 11% compared to last year, which is still not great. It's still a huge loss or decrease in net income. So earnings per share is something that we look at as well, because this defines something called PE ratio, which is price divided by earnings. It's an indication of how cheap the stock is. And as you can see here, there's a decrease of over 5%. And I don't like seeing this, which is decrease of free cash flow as well. I generally like seeing positive cash flow, of course. Okay, and this is an interesting part, because what we had here is a discussion of quarter ended 31st March, right? But when we look at the fiscal year, which means the entire year, you can see that excluding these mark-to-market changes that we mentioned just now, there's actually an increase of 11%. So increase of 11% in the full year result. So I know that everyone's like really negative on China, and I am not, hence why my portfolio is so heavily influenced and has so much China in it. But there was an 11% growth, as you can see, in the fiscal year. So as you can see, the numbers we're looking at just now regarding the earnings per share, there's a 14% increase as well, year over year. So free cash flow decreased as well, year over year, but it's mainly because of this special dividend from Ant Group. So all in all, it's not a terrible result, I would say. It's an interesting one because everyone's so focused on that 96% drop. But if you look at it, okay, they've continued growing for the year, so 11%, which is not too bad. They have had a less of cash flow, which is, I guess, okay. But what's interesting to me is we can look at this, which is the share repurchases. So Alibaba has continued to do share repurchases despite, not having the best results. And they've continued to give a dividend as well. So, we always talk about this on eToro, and, if you're new to my channel, this is something we always talk about. Share price is just a reflection of valuations, but it doesn't mean that's how much a company is giving back to you. So if you think about like share buybacks, it's more tax efficient than dividends themselves. So we don't just look at dividends as like, okay, we receive cash, that's great. But if there's share buybacks, it does constitute a form of the company returning some money to you. So we do like seeing share buybacks and we do like seeing dividends. So we have a 5.1% net reduction in outstanding shares, and we also did have a dividend as well. You can see that here, 0.12 for ordinary shares, and also there's a special one-time dividend as well. So you can see total, I think I did the calculations, you get about 6% return just on this investment, which is not too bad considering interest-free rates or whatever, it's like 5%, so you just get a 1% return. It's not great, but it's still something. And I did want to show you this, which is the different segments, right? So you can see here that Taobao and Tmall Group is 3% growth. So we did note that other competitors like Temu and Tencent and all that, right? They did have a higher growth. And you can see here the cloud intelligence is only 3% growth, which is not great. It's not a large number, but it's not terrible. There is a 45% growth in this international digital commerce group, but what happens here is that this is just revenue. It's still a loss-making entity. You can see here, it's still loss-making. So it's not grown, but it's still loss-making. So the question now really is, should we trim some of this like Baba from our portfolio, given it's such a large, I guess it's a large position. So given it's such a large position of our portfolio, and we do have other Chinese stocks as well, so is it too concentrated? Well, to be honest with you, I'm not worried at all looking at these numbers, because we do like discount cash flow models to see like how well valued these companies are. And I did want to have an Alibaba as opposed to the current stocks that I have in my portfolio. One of the things you notice about the type of Chinese stocks that I have in my portfolio is they're mostly government-owned. 3323, 0390, 0386, 0762, 1186. These are all government-owned entities, so meaning that the Chinese government has a majority stake in most of these companies. I wanted to have something which had a little bit more retail kick to it, meaning it had like more sentiment, more. If you think China, generally people think Alibaba as opposed to like China Construction Materials. No one thinks of China Construction Materials. So I did want to have something in there that could provide like certain type of if retail were to really come back in the Chinese space, provide some rocket returns as opposed to a little bit more boring, even though the majority of it is the boring portfolio. And this is because I'm quite confident in the boring portfolio returning to fairly average valuations and therefore increase in price. But Alibaba, there is a chance, it could go absolutely crazy, especially from a price earnings multiple perspective. Currently, I believe it's trading around 14, which is okay. I generally prefer mine to be in the single digits. 14 is a little bit rich for me, but it does have a potential to go up to like 22. And the reason why I say like 22 or 23 is if you look at Amazon, it's currently trading at the 52 price earnings ratio. So it's not like too far out of a possibility that, because retail suddenly is interested in China again, this goes up to like 22 and therefore we make a decent amount of money. But should it not, I'm more relying on the other boring stocks to kind of prop up that part of the portfolio, because it will benefit should the market come back as well, just not as much as Baba. So just from a pure one stock perspective, it doesn't really have a place in our portfolio and I should reduce it. But because it's part of this larger Chinese play, which I think is very undervalued, I continue to hold it, and I think I might trim just a little bit just because it's such a large percentage, like 5% is quite a lot for me right now. But we will still maintain some position in Baba. And I also did, again, the discount cash flow does show it's still undervalued, so I'm still wanting to hold on to it because of that. So yeah, that's the reason why, that's how I kind of look at all these statements. Every time earnings come out, you have to look at the statements. You have to listen to the conference calls as well to see what you can glean from this, from what everyone is saying. Because it's really important to understand like what's going on in the business, especially if you're investing yourself. And the reason why I do this on eToro is really I want to help a lot of people, as many as I can, help them invest their money as well and show them how I do it. And this way you can get a sense of, not only am I looking after your money well, I'm also generating decent returns.